Hello and welcome back to the Mullooly Asset video and podcast for this week. We're trying something new out here using Squadcast to record our videos and the podcast instead of doing it all sitting around the conference room table together. Brendan, Tom, thanks for joining me on this call. And we're going to talk about what is the big topic of conversation here in the markets. In the beginning of September, we have the Fed meeting next week, and the big question on everyone's mind is if it's gonna be 50 basis points or 25 basis points. So the Fed has been signaling over the last month at their conference in Jackson Hole that the time has come for interest rate cuts. So now the market is trying to digest whether it's going to be 50 basis points or 25 basis points. So want to share some numbers to jump us off here from our friends at DataTrek Research. They do great work, and they looked at the numbers dating back to 1990. So I guess this was when the Fed started being more transparent about what their plan is going to be for the future of interest rates. So there were 5 times that the Fed has either cut by 25 basis points or 50 basis points as an initial cut. There were 3 times that they cut by 25 basis points. July of 95, September of 98, and July of 2019. And just to give some context, in July of 95, they brought rates up from 3% to 6%, and then they started with 25 basis points and ended up cutting by 75 total. In 98, there was the Russian currency long-term capital management debacle going on, so they cut by 25 then, and then in July of 2019, they reversed course from their hiking cycle in 2018 and cut by 25 initially. Just to wrap it up here, then they had 2 50 basis point cuts that were, again, the initial cuts. Those 2 times were January of 2001, just after the dot-com bubble, and in September of 2007, when all the housing market turbulence was going on, and just before the great financial crisis. So only 5 data points here. Don't know if we want to draw too many conclusions from these numbers, but what do these numbers say to you guys?
I think the idea that the Fed is going to cut 50 basis points without some kind of crisis in the media every day, without a crisis, there's no reason for them to be even considering a 50 basis point cut. I I know that I put on social media about a week ago that no one's even discussing the possibility that there may not even be an interest rate cut next week. And I know that's just people can't wrap their heads around that at all. But Powell moves very slowly and he's very deliberate about when changes are coming. And so I think there's always been the possibility, very low odds, that there may not be a rate cut September 16th and 17th. That's a week away. I don't know what they're really going to do. The consensus now seems to be, after the CPI yesterday and the PPI today, that people seem to be settling in around the 25 basis point cut. We know one thing is for sure: the Fed's going to be cutting rates in the future. Friendly Fed is usually the market's best friend. So I wouldn't get too hung up on the timing, though. Brendan, what are your thoughts?
I think another point that Nick and Jess from DataTrek Research threw onto our radar earlier in the week was like, if you compare the current Fed funds rate to the 2-year Treasury yield over history, they track each other within 50 basis points or so of one another, and they are about 1.75% apart now, with the 2-year Treasury yield having moved pretty dramatically lower versus the Fed funds rate. And that's been a good signal historically that the Fed funds rate is about to move for one reason or another. I think what the market seems to be pricing in is there may be a percent or so movement between Fed funds rate and the 2-year Treasury yield. If they were to converge, meaning Fed funds rate come down a percent or so, put it back into the normal historical range of how those two move in conjunction with one another. But yeah, the worry that the Fed might have about doing 50 basis points right off the bat is what it would signal. They seem to be pretty sensitive to their messaging, not only in the words that they use in their public statements, but the implications of it. And so if you look at for us what the 50 basis point moves have meant in the past, it was that maybe the usual things were going on with the economy that would cause the Fed to want to lower rates, but also there might have been some kind of exogenous event going on that would otherwise mean they would have to go above and beyond the usual cadence being 25 basis points. And maybe 25 seems more likely just for that reason alone, because they don't want to freak people out.
I think that sends a message if they jump straight to a 50 basis point cut. When you listen to folks on TV, they talk about 2 years ago, they were talking about multiple rate hikes. And just for the listeners out there, most of the time they're talking about a 1/4 point cut being a single move. So when they talk about the Fed moving over a period of time, 4 rate cuts or 4 rate hikes, what they're really talking about is 4 25 basis point moves. I really think that if they were to jump to a 50 basis point cut for their first move, indicating that they may have data that shows that the economy is weaker than expected. That could be short-term harmful for markets, but long-term, okay. I think Powell is really focused on, how the market reacts to these things. I think them not making a move next week would be taken poorly. I think the market would probably sell off. I think if he gives the market what they're all expecting, 25 basis points and 25 basis points for a period of time, I think that'll just keep things status quo. I think another question that kind of lends to this is how far do they go? If they're talking about lowering rates a 1/4 point at each meeting, how far do they go? Do they do this for a year and able to drop short-term interest rates from 5.25, 5.5 down to 3%? That seemed to be the discussion this morning on Bloomberg.
One of the things I thought was funny was the stats that we had from DataTrek start in 1990, because the information prior to that point is just a little fuzzier in terms of how many basis points they were actually cutting. It was just like, yeah, we did a little bit of cutting, or we raised them a little bit, and so you can't rely on it as much. And people survived pre-1990 when the info that we were getting from the Fed was, maybe less detailed, or they just weren't speaking publicly on such a regular basis. It obviously is going to impact the market in the short term, whether they do a cut, how much the cut is. But big picture, I think the reasons for why the Fed is considering what it is probably better to wrap our minds around than the actual movement itself. So like when the Fed's looking at this, their dual mandate is employment and the rate of inflation. And so inflation's been moderating, but still, as we found today in the report, maybe a little bit sticky. But you look at things like unemployment, and I think that's what they're trying to be sensitive to now when they start considering these cuts. They don't want to overstay their welcome at these restrictive levels and lead to people losing their jobs, because inflation and unemployment are two things that we all hate, and for good reason.
I chuckle after doing this for so long when I see folks in our industry commenting that the Fed is behind the curve. The Fed is supposed to be behind the curve. That actually is where their place should be. Because if they're moving in anticipation of data in the future, they're really creating their own data by doing that. And so the Fed will always be a little behind what's happening in the economy. They're more reactive, in my opinion, than they're going to be proactive. And that's, I
You
think we
love
want
it.
that.
You love it if they could be proactive, but I think you're probably right in that sense. I heard the guys on Animal Spirits this week talking about just reminding, and it made impression on me too, because I didn't remember it this way. The Fed didn't start raising rates in this cycle until inflation was well over 8% already. And so they were behind the curve then. On hindsight, maybe it would have been great if they could have started that sooner. And maybe that means in a perfect world, they had started cutting already at some point this year, but waiting for a little confirmation before they do something as serious as changing the rate of interest that impacts all the other rates of interest in our economy. It's probably the right thing to do, even though it's a little frustrating at times to see them be behind the curve.
It
I
has to
think
be it has to be frustrating to watch. Remember, right before they started raising rates aggressively, they kept talking about the term transitory, that this is
Mm.
going to be a short-term phenomenon that we're going to see. I guess their definition of transitory is different from everybody else's, but yeah, they have to wait until the ink dries on the data.
I think everyone laughs at when they say that they're data dependent now, but it's they have to be. And I think that, Brent, to your point, you want them to be data dependent. You want them to be acting based on actual numbers that they're receiving from the different economic sources, and you don't want them to be acting based on gut feeling or
No, because if they tried to be more proactive than reactive and they made an educated guess, look at the amount of flack they get now for doing what they do based on the data as it comes in. If they were doing stuff based on guesses, I think people would go insane, right? That's like the amount of Monday morning quarterbacking that would be going on. It's already a lot. I can't imagine what it would be like if they were basing these decisions off of projections for the future as opposed to data that we're getting in real time.
I also want to put all of the Fed talk into context because it is, we're drilling down pretty hard on it. A lot of other people are drilling down harder than us on CNBC, Bloomberg, all these different market channels, dissecting 50 versus 25. And to an extent, it is definitely worth talking about. But I think it's back when CPI in 2022, when there was like CPI days and the market would be extremely volatile on those days. I feel like we're in a similar space here with the jobs reports coming in, and certainly whenever the Fed is meeting, we're seeing these pretty volatile days in the market. But in context of the next 3, 6 months, a year out, 2 years out, 5, 10 years out, certainly. Again, I don't know if we're making large or any investment decisions based on what the Fed is or isn't doing. So
Yes,
just
quarter point on the Fed funds rate. Like, what are you doing next week if that happens with your portfolio as a result? Hopefully nothing is my answer. Like if you're waiting for that and doing stuff, I mean, it could be that your MO is just very different than ours in terms of what we're helping folks with. So you could be day trading and maybe that's important to you, but for anyone who's even modestly long-term with their money, I'm not sure there's a whole lot to do as a result of a quarter or a half a point move on the Fed funds rate.
I can vividly remember after the 1987 stock market crash that people were so fixated. We didn't have CNBC back then, but we had Financial News Network. And people were fixated on CPI day, as Casey just mentioned. I had to actually, at that point in my career, I had to look up and see what the CPI was. Like, okay, remind me again what goes into the consumer price index. And we had PPI and we were hanging on employment reports. we were still getting money supply reports on Thursday afternoons after the market closed. And you're right in the sense that this became the next data point on whether we were in a recession or not, if the Fed was going to move or not. So, yeah, I'm getting flashbacks as we go through CPI yesterday and PPI this.
Seems like roughly every year or so, we have a new economic data point that is the most important one. This week's job report is the most important job report of our lifetimes. Like people will joke on Twitter, on the internet, and I am more with the joking than the people who are taking it overly seriously. Of course, this data matters. Of course, it can impact things like the market on a day-to-day, but like probably not making big changes to your investments based on one data point in a series like CPI or unemployment or the Fed funds rate changing as a result of those sort of things. Not to poo-poo it, you want to pay attention. Obviously, it's our job to, so we do. But I think it's important to put it into context and say what matters as a result of this data that we're getting. And it's often a lot less than people, I think, expect because of how heavily the media is reporting on information like this as it's coming out in real time.
Yeah, another one of those indicators has been the yield curve, which we inverted back in around this time. I think it was November of 2022. So just refresh everyone's memory, normal yield curve, short-term rates are going to be lower than long-term rates. So when the curve inverts, short-term rates are higher than long-term rates. We have some more info from our friends at DataTrek. They looked at the three month and the 10-year, which it's usually you look at the 2-year and the 10-year, but the 3-month and the 10-year is even shorter of a time frame. It's one of those tools again that people try and use and say, it's worked this time, it's definitely going to continue to work in the future. And I'm going to throw up the chart here that DataTrek shared. So here you can see that the gray bars are recessions, and when the arrows are indicating when the yield curve inverted. So you can see that every time there is a yield curve inversion, a recession follows shortly thereafter. But what DataTrek pointed out is that in 1990, we had an external event. We had Iraq invaded Kuwait, oil prices skyrocketed, and that coincided with the yield curve inversion. In 2001, we had the dot-com bubble burst. In 2007, when the yield curve inverted, we had, like I said before, the housing crisis, which led to the great financial crisis. And in 2020, we all had the COVID pandemic. It's not necessarily one of those tools where you can say, oh, it was a yield curve. There are external factors that we don't have a crystal ball. We don't know what is going to happen. There are so many different factors at play here. So I think it's just one of those instances where you don't want to draw the conclusion of it happened this time, it's going to happen again. What are your guys' thoughts on the yield curve?
Can you pull up that chart again? So I think I know it's a political season and everybody dodges questions, but I'm going to try and dodge your question here. What I want folks to see on this, the gray bars, like Casey mentioned, are the recessions. And this chart goes back to 1982.
It's a lot of white on that chart.
There's very little gray on there. And folks do the freak when it comes to recessions. I think everybody should just calm down.
Yeah, obviously, from the standpoint of if you can safely assume that a recession is going to occur, but you're not going to be one of the, 5-10% of people that end up unemployed during that period of time, then all you need to really do is have a sound enough investment plan, cash flow plan to get through that period of time. Because as we see, there's a lot of white on that chart. as it relates to the gray, which are the recessions. But I think we spend time worrying about them because of the implications, because we don't know during those periods whether we will be one of the people to lose our jobs or not, because that has huge ripple effects on people's finances, and we could even put them in a position where they have to sell investments
Sure.
while they're out of work. Double whammies. I get why people worry about them, but I think point well made that these are the exception more than the rule. When you look at what the economy is doing, it's usually expanding, not contracting. And the contractions haven't been, super long lived, even over a period of time like that. And so good context to have when we start worrying about things like recessions, like bear markets, the temporary things over the course of history. And while they can be traumatic, I think you can hedge yourself against all the bad that does occur during those periods of time and come out the other side.
All right, so I want to move away from the dissecting the Fed and the yield curve and the economic stuff and move to a more of a planning topic. Kind of want to piggyback off a video I did last week. I spoke about how if you're thinking about retiring early, you might want to save outside of your 401k. But now I want to talk about what if you get into that early 60s, even throughout your 60s? What if you're in that time and you want to continue working? Can you receive Social Security benefits, which is another big piece of the retirement equation when to claim Social Security benefits? Can you both be working and claim Social Security benefits at the same time? So just to give us some context here, CNBC did a retirement survey, and 28% of retirees who are currently retired, 28% of them are working in some capacity. It doesn't give us the ages for how old these folks are, so it could be 60s, 70s, 80s. We're not sure. But for the next generation of retirees, which again is an undefined age bracket, the next generation of retirees, 53% of them say that they plan on working in some capacity in retirement. Again, not sure if this is because they want to or because they think they'll have to, but 53% of pre-retirees think that they'll be working in some capacity. So this is a decision that a lot of people might have to be thinking through is, can I get Social Security and still work? Should I do that? What are the pros and cons of that? To set you guys up a little bit more, there is an income threshold. So you can work and claim Social Security at the same time, but if you make too much money, then some of your Social Security benefits you won't receive the full benefit. So the income threshold here in 2024 is $23,320. So if you earn anything over that, your amount will be, or your Social Security benefit will be decreased. I'm going to share my screen here again and have you guys walk us through the example of how those benefits will be calculated in the future. So
I'll say, as this is coming up on the screen, that Brendan and Tim have popped some people's bubbles in the sense that they have walked in with the concept that, hey, I'm going to retire, I'm going to pick up this other job that I've got lined up, and I'm going to file for Social Security at the same time, and they're 62 or 63. And when we tell them, hey, some of this money is going to get clawed back, you're going to have a problem, it's a real eye-opener, folks.
Yeah, and the further above the threshold you are, the less likely it makes sense for you to do both of those things, both collect Social Security before your full retirement age and earn some income from employment along the way. Notably, though, something like your pension or taking money from retirement accounts during that period of time is not going to impact it. It really is just earnings from employment. And so it's important to separate the sorts of income that you have and think through how they all factor into the overall retirement plan. And that's one kind of wrinkle here to be aware of, I think.
Yeah, good distinction there. So the way that it works is that your Social Security benefit is reduced by $1 for every $2 you earn over the income limit. And that might make your head spin. So let's walk through an example. So let's say on the screen here, your Social Security benefit is $12,000 a year. You earn $35,000 from employment, so wages $35,000 a year. Earnings limit is that $23,320. Got to calculate how far you are over the earnings limit. In this example, you are $11,680,000 over the income threshold. To determine what your benefit's going to be reduced by, divide that by 2. So your benefit's going to be reduced by this number, the $5,840. Subtract that from what your benefit is, and you're going to get $6,160, which is just over 50% of your actual Social Security benefit. So you're only going to get about half of your benefit if you have this amount of earnings per year.
Yeah. So like maybe there's a world where that reduced amount of income is enough to bring it all home for you in terms of, covering your cost. And that's your only option. There's nothing else you can do to get that income that you need. And the reduction is fine. So you choose to collect anyway, but you have to do the math to figure it out, because in a lot of cases, the reduction that you'd be eating makes it not worth it to collect early. You do end up getting some of those benefits that are held back during this period of time. They come back to you past your full retirement age. But if you're talking about the present and what you're going to need to do to make ends meet, you have to do that calculation case that you just walked us through. If you don't, then you're going to be in for an unpleasant surprise.
So important to understand your cash flow, and a reminder that this is for folks who are thinking about filing early before their full retirement age. So if you are in a position where you can wait to file until your full retirement age, for a lot of people now it's becoming 67, you don't have this clawback situation going on. It's only for folks who are looking to file early.
Yep, that's a good point. And like I said, I think Social Security is one of the biggest factors that we help folks decide on when it comes to retirement planning. I think retirement planning, like you said, cash flow is another big thing, investment allocation, what we can expect in terms of return, inflation, longevity, all of those things are factored into our retirement planning discussions. This is a little interesting Social Security wrinkle that like I said, if you want to continue working during your early 60s and claim Social Security, this is a decision that you got to do the math on, and you got to think through fully before you lock in anything.
I think to the point of your prior video, better than being in a position where your only option is to collect early and face a reduction like this. It'd be great to have a liquidity bucket, whether it be at the bank or in something like a brokerage account, like those after-tax investment accounts that are accessible to you and have a different tax status than your pre-tax retirement accounts or your other earnings. It could come up big during a period of time like this, where you could defer that benefit, get a little bit more money, not face a reduction, and still have the income that you need. And so I think that's a good follow-up to your prior point that you're making, Case.
Definitely. If you guys don't have anything further there, I'm all out of topics to throw your guys' way. So I think that's going to wrap it up for this week's video and podcast.
Do we want to talk about the missing Mullooly? Where's Tim?
Tim's running through the woods in New Hampshire or something like that.
It's like a
race,
a relay race, and I guess the first leg of it he's doing is straight up quasi mountain, from what I hear. So he's in for a treat this weekend, from what I understand.
So the running from the middle of New Hampshire down to some beach, and is it a 24-hour race? It's something 100-mile race,
Something like that. I don't think he's gonna sleep or anything. It's just he's got
Maybe-
3 legs to run. Tim, we wish you well, man. Good luck out there.
Yeah, say hi to Goggins for us.
Yeah, exactly. All right. Thanks as always for tuning in. We'll be back with you guys next time.